Hi, I'm Bob Kutschbach, the owner and broker of Carleton Realty. And our topic today is HECM loans, home equity conversion mortgage loans. HECM loans are a type of a reverse mortgage, and there's a lot of misinformation about reverse mortgages and how they work. So let's set the record straight today. The HECM loan is somewhat of a recent development in the mortgage lending industry, and it allows people that are of a retirement age to actually use the equity in their home to handle their mortgage payments, meaning that there are no mortgage payments. So we start off with the first requirement, and that is that you must be 62 years of age or older to get a HECM loan. Now, this is also eligible for a couple, married couple, partners, but both must be over 62 years of age to write the mortgage for the lifetime of both participants. So the HECM loan is for owner-occupants only. You must be over 62 years of age, and you must have a significant amount of equity in the home. The traditional reverse mortgage was one where the lender sent you payments every month to help subsidize your income, and they slowly built up a mortgage against your home. So it was like a line of credit where you were borrowing money every month to help give you extra income in your retirement years. The HECM loan is one where you are buying a house, for example. You're selling the traditional home that you've owned for years. You have a lot of equity in it. And then you put a 50% down payment. And the down payment depends on your age. So the older you are, the less of a down payment there is. The younger you are, the more of a down payment. So let's use, for an example, a 50% down payment, because that's fairly common on a HECM loan. So you sell the home you've been in for years. You pull the equity out of that, and you put a 50% down payment on the new home, the replacement home you're buying. So there is significant equity there, and so the interest is going to compound against the principal over the life of the loan. The reason you have to be 62 years of age is simply because of life expectancy. They want to make sure that it's likely that there will be equity in the home for the rest of your life. Now, there's a lot of misunderstanding as to how this works. Some people think that at the end of the loan, the bank gets your house. Never, never. That's never how it works. At the end of the loan, typically there's no end of the loan unless you live to a very, very old age. But at the end of the loan, you would sell the house, pay off the loan, and keep the equity. Or if you passed away, your estate would sell the home, pay off the loan, and keep the equity. I would love to give you a little example. I put clients into a HECM loan. They were 80 years old. I put them in 4 years ago. Now, it's a $300,000 house, a condo, one floor living. So first floor, bedroom, bathroom, laundry room, everything. No steps. And a beautiful home, brand new condo. And so they're not going to have a mortgage payment. They will have to pay the taxes and the insurance. So you have to have enough income to be able to pay the taxes and the insurance. But it's not a traditional qualifying type of loan. You don't have to qualify for a monthly mortgage payment. All you have to qualify for is the taxes and the insurance on the home. So they bought a $300,000 home. They put $150,000 down from the sale of their previous home. And every year it is going to compound, and their interest rate was 4%. 4% on $150,000. Okay, so $6,000 is going to be added to the mortgage in interest each year, right? But they have a $300,000 loan, and for the last 4 consecutive years, it's appreciated at 6%. 6% for 4 years, 24% on $300,000. So you can see how their equity is growing every year. Rather than the perception that they'll have less and less equity every year, This couple has far more equity today in their home than they had when they first took out their HECM loan. Now, here's some facts that seem unbelievable. It is FHA insured. It is FHA insured. So there will be some mortgage insurance added onto the loan. Yes, that's the downside. But the upside is that there will be no personal liability for the loan. So let's say that we have a very bad situation where the market goes down. The market go down 50%. So now the home isn't even worth what you owe on it. You can literally hand the keys back to the lender and there's no liability. So worst case scenario, if real estate market tanks, they will not come after your home. You can simply give it back to them. Let's say that you live an incredibly long life, okay? According to the last Guinness Book of World Records, a 122-year-old woman was the world record. Let's say you live to 122 years of age and you literally compound that mortgage past what it's worth. No liability. They can't come back on you. They can't come back on your estate. You just hand the keys over. And again, all those years you've had no monthly payment. So that's the incredible truth about this loan, is because it's FHA insured, there is no personal liability. Now, there would be personal liability if you don't maintain the house. If you let the roof leak and it destroys the house, there could be personal liability. So the only liability is you must pay the taxes, the insurance, and must maintain the house so it doesn't become destroyed. So if you'd like more information, I invite you to contact a Carleton Realty agents. We have brochures we can send to you, or contact a HECM lender. Again, HECM is Home Equity Conversion Mortgage. So if you'd like more information, let us know. And thank you for watching.